Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.isc.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Let's see. So I don't know. I mean, I've kind of run through, really, I guess what I wanted to talk about. I don't know, Katrina, if you got any feedback, if people want me to go over other points or anything.
We actually do have a question from Sarah asking, to what extent is index ETF volume in major indices and others an indication or a proxy for the share volume in the market and or total activity that includes futures?
Well, it's interesting because options, kind of index option trading is so heavily weighted to SPX that if you were to strip out all the SPX trading and indexes, you really wouldn't have a whole heck of a lot of anything left there, believe it or not. So I mean, again, in the same way that I talked earlier about SPY trading and options on SPY, I mean, these two things are just, they're really kind of anomalies, within the market, and so it's difficult to pin down to say, oh well, if there's lots of trading here, it means more trading there. Like I said, with SPX and SPY, they're just they're the grandfathers, the granddaddies of all this stuff, and so they receive kind of the lion's share of all the trading. I don't know, like I said earlier, issuers want to see options activity on their product, and of course options market makers and participants want to see the activity in the cash market too. So I don't know if that 100% answered the question, but
yeah. So I have a question right now from Bill. What about liquidity of indexes when the markets have strong moves? What happens when everyone wants to sell because of a panic?
Okay. Well, this is good actually, because what I'm going to do is I'm going to stop sharing my my Excel screen and actually share a different screen. And I can talk a little bit about this. And this comes into, I'm actually going to talk a little bit about the flash crash. And so I'm going to share. Okay. Yeah, so what happens when, let's see, I'll go here. Okay. So everyone can see my Bloomberg screen here?
Yep.
Yeah, okay. So what happens when there's a mad rush for an ETF, right? Does the pricing go out of whack? What happens? Well, there's a couple of different things that could happen. Back in the summer of '08, those of you who follow oil and natural gas remember USO and UNG, specifically USO. Or was it? I guess it was both of them. But anyway, so USO and UNG are 33 Act products, and what that means in a nutshell is that when they were launched as a shelf offering. All right, so the traditional kind of creation redemption process you associate with an ETF is not in place with those products, right? Because they are 33 Act products, they are securities, not funds, etc. And so when they want to issue new shares, they actually have to petition the SEC and say, "Hi, we'd like to have a follow-on offering. We have to have a secondary offering or some other means to get shares out into the marketplace." So what was going on at that time was a kind of a confluence of events. One was that they were at the point where they needed to petition the SEC to say, "We'd like to have a follow-on offering," but there was also a lot of noise surrounding position limits, futures position limits, and so there was a point there where they weren't sure, even if they did make the registration for a follow-on offering, that they would get approval. And so there was a lot of confusion. There were lots of things going on, and as a result, they didn't issue more shares. It was a period of about maybe three or 4 weeks or so. Well, anyway, we saw the fund trade up and trade up and trade up, and ultimately, the fund went to about, I think it peaked at like a 19% premium to its net asset value. All right. As it turns out, they kind of the scare of position limits kind of went away. The issuers modified their model so that they could now accept swaps in lieu of futures positions, and then they as well made their application to do a follow-on offering for shares, and everything kind of settled down, right? So that's kind of an extreme example of what can happen when you have more demand than there is supply. Now, in the case of ETFs, where you have this creation redemption process, there might be a little bit of a move on the price of the ETF itself, but ultimately, again, you go back to this this model here, and I'm sorry, I'm going to jump once more. Except where did I go? Oh, okay. Okay. I was just going to jump back to my model and shared. Sorry, bear with me here. Here we go. Okay, so everyone's now seeing the previous model in Excel, yes?
Yes.
Okay, so take this $5,000 trade and say it's a $40 million trade. Okay, so we got some big numbers here, and let's see what happens. Now, in terms of the fund, right? Trading at the fund level, of course, that's going to blow both books away, right? 1,100% of ADV on PHO, 16,000% of ADV for FIW. So we're going to be doing baskets. And at the end of the day, I usually say, at the end of the day, we all go home. No, but what ends up happening here is that, say you have this $40 million trade that goes through. It will impact the underlying markets for these constituents, right? And if we flip over again to the FIW page and we look at this and we say, okay, here we have some big numbers, right? We have this one name here. This is going to be 137% of ADV, so that thing's going to get hit. But there are other names in here. It's a 2% ADV in one name, 4.5 in another, 42. Yeah, it's kind of a lot, but still you can kind of stomach it. So I mean, when you really look at this, and you look at all these ADVs on this. Now, mind you, this is a $60 million, $66 million fund, and I'm putting a $40 million trade through it. But really, when you look at these names, maybe that top name at 140% of ADV, maybe the manager might work that over a couple days. But otherwise, you could probably put those trades in pretty easily. Maybe you're a quarter, maybe you're a third of ADV. It's not ideal, but it'll be a lump that those individual markets on those equities will swallow, and they'll probably swallow it intraday. And people will know, there was a big trade in this fund, and it went. I mean, so yeah, there can be impact on the component level, in the markets of the components. But when you look at the individual components and what kind of impact that would be, my guess is that if the index is designed well enough, this is kind of what you would see. You would see some names where it would be a blip on the radar. You would see some names where it would be a lot, but it would be manageable. So yeah, I mean, you see big trades come through. There are impacts, but they're manageable. So again, I don't know if that answered the question or raised more, but I don't know if we have any other follow-on, Katrina.
We have plenty of questions, actually. John wants to know whether or not your analysis provides any trading opportunities.
Well, this is interesting because when I first developed this spreadsheet, the two numbers that I looked at, for instance, with FIW, I looked at these two numbers that I had come to, and I said, okay, I have a 3-cent spread on shares of a fund, but I have, say a 2-cent spread on the basket. And I was trying to think to myself, what is the trade? What is the trade? Is there any way to scrape that penny? And what you find, of course, is that there are lots of places, lots of market makers, and even shops that have opened up. And what they do is not necessarily this trade that I'm talking about, but what they do is they look at what's the market price and what's the net asset value. What's the IIV essentially of the product. Does it make sense for me to buy shares of the fund and deliver them against the basket price, or vice versa? It depends on how much spread there is in there, and then of course that spread really it's your trading costs, which are going to drive this. And unfortunately, I think if you went to any of your kind of average broker-dealers and said, I'd like to be set up so that I could basket trade, the constituents of ETF XYZ, I'm sure that the fees would be so exorbitant in relation to, the opportunity that it just wouldn't make sense to do it. And unfortunately, that's, part of being a retail trader, but that's just kind of the way it is. But as I said earlier, I was looking at this and saying, really, what is the trade? I've got something now at 4 cents wide. I've got something at 2 cents wide. How do I make that 2 cents, right? Now, of course, folks who trade like this, like the guys on the night trading desk or the guys at Wallach Beth, will kind of scoff and say, yeah, that's kind of cool, but you're just taking top of book, and I can dial up my guys, and I could do better than the displayed price. And a lot of times they can't. So again, from a retail perspective, this is, I think, interesting. But I honestly I don't know, as a retail trader using quote retail resources, how you can realistically take advantage of scraping a penny or two, and having it be cost effective. So sorry. All right, what do we got, Katrina?
Right. TJ wants to know, do the options have enough liquidity to day trade?
Yeah, I mean, the options for which?
He did not specify.
Okay. Generally speaking, I mean, I said earlier I was talking about the bid and ask of quotes, and while they are suggested prices, if you wish, they are real prices, right? So if you go and you're looking at an options contract, and you're looking at, say, a series, and you see that, geez, there's really not a lot of open interest out there, and the quotes are really wide, maybe they're 40 cents wide or something, and you say, I'm not going to trade that, 40 cents wide, there's no open interest. But the point is that regardless of open interest, maybe you see something that the rest of the world doesn't. And with regards to open interest and spreads being wide and stuff, put in a limit order, right? If people walk by, it's kind of like walking by the window and seeing something with a price tag on it and saying, "Oh, I'd never pay that," but you kind of really want that thing. Go in and talk with the store owner, right? Say, "Hey, I saw you're selling this thing for $5.40, but I'd really like it at like $5.10. Can you do that?" And you do that by putting in a limit order, right? So if you see a quote in the options market and you're looking at all the other stuff and saying, "Geez, I haven't seen any volume today, and I don't know, there's really low open interest," there's a quote there. There's somebody there making markets in this thing. They will trade with you. You just got to work out a price that you like, and the trade will get done.
All right, and we have another question from Nicole. If someone wants to enter the market via creation and redemption, how long does that take? Is this something that really can be done to take advantage of momentum or not really appropriate?
Well, in order to become an authorized participant, that is something that you would have to set up with the issuer. And so there are, I don't know if I'd call it a registration process, but either through their website or just calling them up and call up their 800 number and say, "Hey, I'd like to become an AP for your ETF products." There are fees involved in participating as an AP, but you can do it. I'm not sure if there are. I'm pretty sure that there are liquidity requirements. I just don't know what they are. If you think that it's something that you want to pursue, by all means call up somebody and find out more about it. In fact, if you look through the prospectus of any fund, you will see a detailed explanation of the creation redemption process, and as well the fees associated with actually transacting. So.
All right, well, let me see if there are any other questions. It looks like that's about it at the moment, unless anyone has any additional questions they wanted to tack on right now. That looks like a no.
Okay. All right.
Correction, we actually did have a couple more questions.
Okay, it's fine. I
spoke too soon. Tina is asking, could you explain more about the difference between ETF and basket percentage ADV?
Sure. In this spreadsheet here, the ETF percentage ADV, let me change this back from 40 million to just 1 million. What this is here is, if I look at this $1 million, in fact, why don't I do this? So we see here, that's okay, coming into it. So what we see here in this 28.71% for PHO against $1 million is, if I have $1 million that I want to invest in, say, PHO, I would look at the volume, or sorry, well, essentially the average dollar value traded in the past 5 days, which in this case is this PHOJ3. Sorry, I'm just going to flip around quickly here. Okay, so we see here that in the past 5 days, the average daily dollar amount traded in PHO is we'll call it 3.5 million. Okay, so when I go back to here and I say I want to flow $1 million through the fund, well, that turns out to be about 29% of what would normally flow through the fund in a day, right? And again, with FIW, it's a smaller number, so it's going to be, like we said, this roughly 4 times number. Okay, now that's assuming that I'm going to fill my order just on the order book for, say, FIW. I'm going to go to the market maker for FIW and say, based on the the shares you hold and the liquidity of the ETF, here's $1 million. and that's going to be 4 times the dollar value traded every day. That's going to be a big, nut for them to swallow and all that kind of thing. When you look down at the second level where it's this basket percentage, right, that is saying, okay, I'm not going to place this trade in terms of shares of the ETF, but I'm going to place the trade in terms of, daily value traded of each of the components of the ETF. So instead of going out and buying, which in this case would be, this 44,000 shares of FIW, I'm going to go out, sorry for bouncing around, folks, I'm going to go out and I'm going to buy, 17,000 shares of Energy Recovery, 12,000 shares of Flow, 1,100 shares of Pentair, et cetera, on down the line. And when you look at these share numbers as compared to their average daily value traded, right, it's a much lower number. And so that's really the difference between those two figures, and then really kind of the kind of crux of the argument here, right, that when you start talking about trading an ETF in size, you're really getting away from looking at kind of the top line liquidity and getting into what I like to call look-through liquidity, which is I'm looking at the liquidity of the components of the ETF, right? Okay.
All right. I think we'll take one final question. Whitney wants to know if we can provide a copy of the spreadsheet.
I can. This spreadsheet is enabled with some data exchange links to a Bloomberg terminal, but I could certainly freeze those links for the data anyway and provide the spreadsheet. Yeah, and if people want to go, like I said, pretty much all of this information is available either on issuers' websites. I imagine if you have a savvy teen in the house, you could probably get them to hook up some kind of RSS feed from Google Finance or Yahoo Finance or something to pull in prices. But sure, yeah.
Okay.
All right.
All right, so I think that should do it. All right, our thanks to Mark for sharing your insights today. Thanks to all of you for joining us. If you'd like to learn more about the First Trust ISE Water Index Fund that we discussed today, please make sure to visit ise.com/ETF. You'll be able to find more product info, articles, and a link to sign up for some free trade alerts that can help teach you how to trade some ETFs. These are actually really great for investors who are new to the product, and they're a free tool that we offer to our webinar attendees. We do have a lot of resources available, so if you're looking to trade products based on these industries and sectors, make sure to take advantage and visit the website. If you do have any questions or comments, send us an email. The email is webinars@ise.com. Thanks again to everyone for joining us this afternoon. Thanks again to Mark, and we hope to see you all back next time.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.